textile outlook will be driven by industry's ability to maintain healthy capacity utilizations, improvement in the domestic demand scenario, gross margins in cotton as well as man-made yarn, and government support to this sector. The improvement in credit profile of textile companies will be backed by better working capital management, containment of long-term debt due to limited capacity additions, and benign interest rate regime. Therefore, we look forward to stable outlook for textile industry for financial year 2018. We expect most large and mid corporates to deleverage their balance sheets in financial year 2018 in preparation for the next expected investment cycle over financial years 2019 and 20. For financial year 18, there are expectations of limited capacity additions in spinning. However, weaving and garmenting units would raise moderate debts to expand their capacities under TUFs. Soft interest rates would aid strong interest coverages. Cash levels for large and diversified industry players are at comfortable levels, though liquidity position of smaller players will remain affected due to spikes in cotton prices over first half of 2017, followed by demonetization in second half of 2017. We believe that Indian textile companies are in a fair position to increase their share in textile and apparel exports at the cost of China, which is losing its piece in the global trade. Other textile exporting nations like Vietnam, Thailand, and Bangladesh have been taking advantage of the declining Chinese share in textile due to China's shift to high technology sectors amid rising labor cost. However, India's competitive position is compromised by cost inefficiencies due to fragmented operations, poor transportation infrastructure, and unfavorable taxation structure. Nonetheless, China's shift away from textile provides significant opportunity to India despite structural disadvantages due to trade barriers for India and US and European markets. India's share in global textile trade is likely to increase based upon its dominant position in cotton production, integrated fiber to apparel capabilities, reducing power cost, government stimulus to exports, decreasing interest rates, and relatively stable currency regime. Exit of the USA from Trans-Pacific Partnership would realign investments to Indian subcontinent, which were going to Vietnam and Thailand over financial years 16 and 17 in preparation for the Trans-Pacific Partnership. We expect textile companies will be cautious before making any large-scale greenfield investments, though small to mid-scale investments are expected to be committed, especially into the apparel sector. Centre's tough stimulus would not be sufficient to push up the capacity addition amidst global slowdown. There has been a visible shift in Government of India's budgetary allocation towards reduction of the indirect tax burden compared to the higher capital subsidy support provided under TUFs prior to 2015. Thus, capacity additions would be funded through higher private investment rather than capital subsidy support in the future, though investors are in wait and watch mode till the global market recovers.